Good morning, everyone. Very excited to be here and get to talk a little bit about environmental, social, and governance investing. And first, we'd just like to thank Hank and the NCPERS board for having me here today. I think it's interesting. Just a few years ago, when I would be asked to speak about ESG, it was typically in a very small room with a few diehards. So it's quite exciting to see it really kind of shift to the mainstream discussion, and I think that's going to continue. So I think just before I start getting into the heart of the presentation, it would be helpful just to sort of define what we mean by ESG. A lot of acronyms are being thrown around, and I think to be more specific and clear about what we're discussing here, the CFA Institute defines ESG as a broad set of sustainable investing criteria used alongside traditional financial factors in managing investments. Some examples of environmental issues would be, and forgive me if these are quite obvious, but air and water pollution, energy efficiency, waste management. Social criteria really span a broad range of issues. It could be human rights related, labor standards, customer satisfaction, data privacy and protection. And governance, perhaps this is the most obvious category, would include topics such as board structure, audit committee structure, executive compensation. So with that as the baseline, I'll just start with a few kind of interesting headlines that some of you may have come across here in 2019. I think that really kind of illustrate the global scale of these ESG issues. Whether it's China pushing ahead pretty aggressively with environmental reforms, which interestingly are extending to their massive infrastructure project called the Belt and Road Initiative, or in Mexico, where the new president, Obrador, is really pushing for banks to lower fees and reduce commissions to try to boost financial inclusion, that is, bring more Mexican citizens, the millions of which are outside of the formal banking system, bring them into the fold. Kenya is embarking on some green bond infrastructure finance projects this year. And then in Australia, the bank regulator is expecting banks and insurers to start to take climate change into their risk management processes. So really all of these are examples of government policies that are stimulating actions on ESG. But perhaps more interestingly, when we look at some specific company examples, I think these will probably be more familiar to you. Certainly with Boeing, facing significant headwinds with respect to aircraft safety on their most profitable business, the 737. This is having material financial impact here in the near term on Boeing. Or Brazil mining giant Vale, which has experienced its second tailings dam collapse in the last, I think, 4 or 5 years, killing hundreds of people, including their own workers. Again, very financially material to their share price and bond prices. Closer to home, Pacific Gas and Electric. We're all familiar with the wildfires and issues of faulty transmission lines and perhaps delayed maintenance on those. And so again, we're seeing these issues really come to the fore and have a meaningful impact on returns across different asset classes. So I would just assert that ESG is more than a buzzword, a convenient industry buzzword or a fad. You are seeing these issues become much more material, as I said. And when we think about ESG integration, which is the topic of my presentation, it really is the analysis of all material factors in investment decisions. And I think you're seeing this discussion move beyond just socially responsible investing or investing for one's personal values or perhaps institutional mission. This is really more about investing for value, investing for strong risk-adjusted returns, as there is a growing appreciation of the financial materiality of these issues among institutional investors. But I do note that skepticism remains, and I think that that's an important point, which we'll try to address here. So ESG by the numbers, I thought it would be interesting just to include some of the numbers here in terms of signatories to the Principles for Responsible Investment. This is the largest network of asset owners, asset managers, and institutional investment consultants who have committed formally to integrating ESG considerations in their investment process. So there's been an explosive growth in the number of signatories, I think from 100 back in 2003 to over 2,000 today. 50,000 companies are now covered by ESG ratings. So there's a big business of ratings and ranking companies on their ESG profiles, and investors are increasingly, subscribing to those and using them in their process. And I apologize for the kind of the small charts here, but on the lower left, I'm just illustrating the growth in U.S. assets that are managed according to ESG integration or dedicated ESG strategies has increased about 200% over the last 6 years, up to $12 trillion as of 2018. And I think even more interestingly, on the lower right, you've seen a big increase in the percentage of earnings calls by S&P 500 companies where corporate executives are actually referencing sustainability terminology. And again, I think that's reflective of real business materiality. And so some of the drivers of ESG growth, just quickly, I think naturally you're seeing economic and regulatory pressure. Think about clean energy policies at the state and local levels, despite, I think, certainly some hesitation with the current presidential administration. You are seeing movement more at the local levels. Certainly shifting demographics, societal attitudes, customer preferences. You have the rise of the millennial generation and the post-millennial generation, and they have different consumption patterns. Surveys show that they're more than willing to pay up for sustainable products and services, and they want to work for employers who respect social norms and are looking to embrace diversity and be more inclusive. Certainly media coverage is really off the charts. I showed you a few headlines, but I think more importantly, the impact of social media in terms of focusing attention on hot button issues like executive pay, workplace discrimination, sexual harassment. These are very important topics that are in focus on Facebook, Twitter, et cetera. And so as a result, as I said, you are seeing companies start to integrate more of these considerations into business strategy. This is clearly evidenced by surveys of corporate executives. This is some survey data from the World Economic Forum. On the left side of the page, I'm showing the results of the survey for the top 5 global risk factors 10 years ago, back in 2009 and 2010. The boxes that are shaded in blue are what World Economic Forum defines as economic factors. So back then it was asset price collapse, perhaps not surprisingly coming off the global financial crisis, slowing Chinese economy, retrenchment from globalization. And then you fast forward on the right side of the page to the last few years, and you see in green Environmental issues are at the top list of risk factors. Extreme weather events, natural disasters, failure of climate change, adaptation. And so again, businesses are calling out that these issues are increasingly affecting their bottom line. So, what about performance? There are still, a lot of skeptics out there. I think the good news is we are seeing increasing, pretty rigorous research being done in academia and in the industry. So starting with academia, Harvard Business School, Professor George Serafeim a few years ago did a very intensive study looking at ESG factors through the lens of industry materiality. And what that means is, companies, everybody has different exposures to these issues depending on the industry you're in. And companies may be producing kind of glossy sustainability reports talking about corporate philanthropy efforts, but you really need to focus in on what's driving your business, what's material to your sector. So what Professor Serafeim showed was when you adjust for those factors, think about beverage companies or semiconductor companies that are water intensive in their manufacturing processes. To the extent that those companies are managing those risks and seeking to become more efficient, you're actually seeing that pay off in terms of reduced costs or perhaps even revenue opportunities. And so what Professor Serafeim showed was focusing on industry materiality actually increased alpha by about 600 basis points relative to firms that were focusing on immaterial factors. So think of banks putting solar panels on their roofs of branches, which is not a bad thing, but perhaps they should be investing more in information security and data privacy, more material factors. And then shifting gears to more industry-focused research beyond academia. This is a study that Bank of America put out last year. This is their quantitative research team, very talented and bright individuals who looked at the contribution of ESG factors, so companies that are scoring well on environmental and social performance and that have strong corporate governance. And when you combine those factors with traditional quant factors like dividend yield, earnings per share, revisions, earnings momentum, you see positive alpha contribution really across the board. And I think perhaps most interestingly, the quality factor, it was additive to a quality factor scenario as well, because a common criticism of ESG is you just get it by investing in high quality. Certainly there's a correlation there, but this research would indicate that there is value to be added above and beyond just a pure quality factor. Even looking at a basic ESG kind of best-in-class index, and this is focusing on MSCI, one of the leading index providers, looking at their ESG index within emerging markets equities. I apologize, I know it's a little difficult to see, but this is looking at cumulative performance history back to 2007 through last month, or the end of April. You've seen this emerging markets ESG best-in-class leaders index outperform the standard MSCI emerging markets benchmark by almost 400 basis points annualized per year, with a Sharpe ratio more than double that of the index at 0.3 versus 0.15. And perhaps this, I think the fact that you're seeing these strong results in emerging markets is indicative of the fact that they're lagging developed markets in terms of weaker corporate governance standards, poor environmental track records, but there is scope for improvement. So to the extent that you're focusing on companies that are addressing those issues, there's potential alpha to be had there. So certainly more work needs to be done here, but I think it's encouraging some of the evidence that we're seeing. So to take a step back and just think about institutional investor adoption, this is a survey that Callan Associates has been doing for the last 5 or 6 years of institutional plan sponsors. And what we show here, perhaps not surprisingly, is that adoption in terms of ESG integration is highest among endowments and foundations, both of which are around 60% adoption rates. But public funds that come in at 40% of funds surveyed that are integrating ESG, public funds are where you're seeing the fastest growth rates in adoption over the last 5 years, up about 21% on a compound annual growth rate in terms of funds that are looking at ESG. And how are they doing it? And so again, this is the same Callan survey. Interesting that a few years ago in 2016, the most common response in terms of how plans are looking at ESG issues was, well, we added language to our investment policy statement. But what you've seen more recently is actual words becoming action in terms of funds that are considering ESG integration within manager selection. They're communicating to their existing investment managers that ESG is important to the fund. And some are even engaging with corporate management, voting proxies, and filing shareholder resolutions. And this has certainly been my experience is a lot more clients here in the US are asking us, are we signatories to the principles for responsible investment? How are you integrating ESG? We want stock examples. When did it weigh into a buy or sell or trim or add decision? So the questions are getting more complex. So among the 40% of public funds who do integrate ESG considerations, Callan also asked them, why is that so? And the top responses were that it's consistent with fiduciary responsibility and it improves our risk profile. And then a smaller percentage indicated higher long-term returns. Maybe more interestingly, for the majority of public funds who noted that they don't incorporate ESG, they said the vast majority said it was because they will only consider factors that are purely financial in nature, and there's a lack of research tying ESG to alpha generation or an unclear value proposition. I think these are valid criticisms, but as I've already indicated, I think as more studies come out, as more data on ESG is produced so that it can be analyzed by academia, by investment banks, investment managers, asset owners, I think you're going to start to see these concerns fade over time. And importantly, I think it's this concept of industry materiality and what companies really need to be focusing on with respect to sustainability. As that really takes hold, you're going to see this trend start to shift. So one of the, I think, common barriers to approaching ESG is it's just tough to do. There's hurdles to integrating this data. The landscape is changing, more disclosures are coming out, more data sets. So the quantity is increasing, but the quality is not always there. There's a lot of boilerplate language within corporate sustainability reports. And as I said, a lack of materiality in certain instances when you think of perhaps banks investing in solar panels for their branches. But still, we think more information is better than less. But scrubbing that is important. ESG ratings can be useful, but they do have their limitations. So I would just say resist the urge to use those as sort of a one-stop solution. There are biases in the ratings, which I'll discuss here momentarily. And really doing ESG integration in a thoughtful, authentic way takes resources. It takes investing in perhaps new specialists on investment teams, training your personnel on what are the material issues you should be focusing on for your specific sector or industry. It may require investing in new technology to kind of capture and scrub these the increasing amount of data that's coming out. So just really quickly to touch on the issue of ESG ratings, what I've illustrated here on the left side of the page is the market cap bias that's inherent in ESG ratings, given that they do reward corporate disclosures, and those tend to be more prevalent among larger cap companies that have the resources to devote to sustainability reporting. And so this is taking ESG ratings from one of the leading providers, Sustainalytics, and again, you see that skew from micro cap to large cap on the left side of the page. On the right side of the page, these are the scores sorted by region, where you see Europe and Australia coming in with the highest scores, followed by Asia and then North America. And then certainly, less developed regions like Latin America would be much lower on their scoring profile. So the point there is small cap companies, emerging markets companies who may be actually doing innovative things around ESG often are overlooked by these traditional ratings frameworks. So what I would assert is you really need to embrace the imperfection of ESG information and do the work. Resist the temptation to rely on outside research and scores. You can have more interesting discussions with management that really shift the dialogue beyond quarterly earnings and really start to tap into what's driving their long-term vision for the company, and really frame that risk-reward from a longer-term perspective. So you need to look into kind of non-obvious factors, as I specify here on the second bullet. You look into how they're treating their employees, how they're managing supply chain risks, what's their view on diversity, and across the board, but importantly in senior management positions. How are you managing emissions intensity for energy-intensive businesses? And I think the good news is there is more actual numeric data coming out that is useful in answering some of these questions. So this is an analysis of disclosure rates on specific numeric metrics that companies are increasingly reporting on. And this is looking at the MSCI All Country World Index, so that it includes the US, Western Europe, developed Asia, emerging markets. It's the entire global investable universe, and what you've seen is a significant uptick in disclosure rates from the 30 to 40% range just 10 years ago to 50 to 65% today on factors like women, diversity, percentages, total greenhouse gas emissions, energy usage, water withdrawal, and waste. And so it's important because these metrics can provide very useful inputs into fundamental research. And I'll wrap up here with a few kind of concrete examples. Potential applications for fundamental research would be focusing on companies that have explicitly sustainable products or services that could be tied to the transition to renewable energy, whether it be offshore wind or solar, health and wellness trends, consumer behavior increasingly, consumer demand increasingly driving trends in health and wellness, or an area like microfinance within emerging markets where a lot of people, as I said earlier, fall outside of the formal banking system, and these are very small ticket loans, but there's very interesting companies that are doing a lot of good work in these areas, and so you can choose to focus in on companies that are directly addressing those needs. There can also be policy support for those areas, like China's ongoing environmental reform, providing attractive investment opportunities potentially within electric vehicles and batteries within China. So there's a lot of interesting innovation there. The other way to look at it or approach ESG is by trying to identify companies that are just embedding it in their business operations in terms of human capital investment, supply chain management, diversity, some of those issues which I addressed on the previous slide. And so, a specific company example, which I'm not really allowed to name the companies, but this is I think a 13 billion market cap, publicly traded chemicals company based in Denmark, which one of their businesses is food ingredients, specifically dairy cultures and enzymes, and they're doing some innovative work in what they call their bioprotection segment, which specific products can increase the shelf life of yogurt by about a week, which is very very meaningful in terms of reducing yogurt waste within Europe, and they measure specifically that this product can contribute to a reduction in waste by about 30%, and that equates to over 500,000 tons of carbon dioxide emissions. At the same time, they're addressing consumer preferences for a healthier diet. So how could this impact your investment thesis or valuation? You could look at the potential sales growth opportunity for this product, which I believe is driving growth, top-line growth of in excess of 20% per year over the next 5 years is what the company is projecting. So to transition to more sustainable operations and companies that are just sort of embedding it and how they manage their business, there's a really neat small cap Swedish biotech company that's doing some innovative work in terms of taking the use of toxic chemicals and solvents out of the drug manufacturing process, so their product can enable a more environmentally sustainable drug manufacturing process, which their pharmaceutical company customers certainly appreciate. And again, this is a growth initiative for them. This isn't just sort of window dressing. Or a leading global IT services company based in France, where half of their employees are based in India, doing a lot of work in outsourcing. And many of those employees in India are young mothers who are struggling to raise their families and struggling with that work-life balance. It's very important to attract and retain those women because they're very talented, and having flexible work-life balance and policies in terms of work from home or providing complementary transport to and from the office when they do need to get to work, that's very material to this company because it's a human capital intensive company. And it's paying dividends in terms of attracting talented employees and retaining them, and they're more productive, and again, you see that flow through to the financial performance. So I'll just wrap up by trying to make the point that the drivers of corporate financial performance are evolving, and so should the inputs to investment research and portfolio management. It may sound a little cliche, but doing well and doing good are not mutually exclusive. And, I would emphasize that you shouldn't compromise your objective of providing financial security for the 22 million active public servants and retirees who depend on you. So don't compromise. And I'll pause there. Thank you very much.
This session will give an overview of the Guide to Alternatives and new resources across real estate, infrastructure, private markets, and hedge funds. Led by David Leibowitz, Executive Director at JP Morgan Asset Management, this session will simplify the complex world of alternative investments, helping investors to improve the information. Please welcome David Leibowitz.